McQuestion. For over 25 years, talking about things that matter with people who care. Production of McQuestion is made possible in part by individual viewers, supporters of the Foundation for Responsible Television, CF Accountants and Consultants, adding value to clients throughout the region, the University of Texas at Dallas, creating the future.
If the average person were asked just what caused the 2008 financial crisis, they'd probably say something like this. It was a failure of capitalism. It was greed. It was Wall Street cronyism. It was not enough regulators, or it was the perfect storm. Well, the real facts are different, and they matter because some of us happen to believe that understanding the causes of a problem come before applying solutions. Just as importantly, understanding the causes may help us prevent the next financial crisis. To help us understand just what happened and why are two experts here in the studio, so let's meet them. First on my right is George Selgin. He's a senior fellow and director of the Center for Monetary and Financial Alternatives at the Cato Institute and professor emeritus of economics at the University of Georgia. And I would say one of the things I've liked about reading your stuff over the years, George, is you're an advocate of free banking. And there are probably you and I and two or three other people in the audience, and there's one person there who knows what free banking is. We're not going to talk about it today, but I like your writing in that area. Sitting next to you is Peter Wollesen. Peter Wollesen is the Arthur F. Burns Fellow in Financial Policy Studies at the American Enterprise Institute. He was a member of the Financial Crisis Inquiry Commission, which was established by Congress to tell the American people why we had a financial crisis. His dissent from the Commission's report led to his writing this book, which is called Hidden in Plain Sight: What Really Caused the World's Financial Crisis, and more ominously, why it could happen again, Peter. So thank you very much for this book. It's an excellent book.
Thank you.
So let me just ask you to tell that viewer now why we're still talking about this 8 years after the financial crisis.
I think the main reason we're still talking about it, at least let me put it this way, the main reason we should be talking about it is that the financial crisis was described as a problem of the private sector. The private sector had done some bad things. It had resulted in a crash, and what we have to do is to regulate the private sector more fully. So we got something called the Dodd-Frank Act as a result of that. And the Dodd-Frank Act has caused a very slow recovery in our economy. And as a result, many people are very eager to see the Dodd-Frank Act reformed in some way. But we won't be able to reform the Dodd-Frank Act until people really understand what caused the crisis. Because if they think the private sector needed more regulation, they got it through the Dodd-Frank Act. And unless they understand that there was another cause, which I hope we'll have a chance to talk about, we'll never be able to reform that act.
Okay, good. I want to look at graphic number 7, Peter, and tell us what we're looking at here and why it's important to that person watching this program.
What you see on that graph is, and actually this is prepared by the Federal Reserve Bank of Dallas, and what it shows is the normal recovery from a recession since the mid-1960s. That's the black line in the shaded area. The black line is the average, and the shaded area is all of those recoveries. The red line near the bottom is the recovery from the last recession. And we all know that that recovery has been very slow, about an average of 2%, whereas former recoveries were 3%, 4%, and 5%. So that, I think, is the result of the Dodd-Frank Act, which has suppressed financial activity substantially throughout the economy.
Okay, now I would say if we had time on this program we would talk about this, because there are other people who would say, Dean Baker and Paul Krugman would just say, we should have spent billions and trillions more on just pumping things up. That's the fiscal policy, but we're not going to talk about that. Here's what we are going to talk about. House Financial Services Committee Chairman Jeb Hensarling, Republican from Texas, is here in Dallas. He's in D.C. today, but I interviewed him 3 weeks ago, and I asked him the question I'm asking you two, and that is, what really caused this financial crisis? So let's see if the House Financial Services Chairman knows what caused the crisis. When you're ready, let's run video clip number 3 of Jeb Hensarling.
Well, the major cause of the financial crisis was really that we saw an erosion of traditional underwriting standards in real estate. And the number one reason that that happened was, frankly, bad federal policy. We didn't suffer from deregulation, we suffered from dumb regulation, and there was no dumber regulation than the affordable housing goals of Fannie and Freddie, which were neither fish nor fowl, but they were basically institutions that practiced capitalism on the way up and socialism on the way down, levered approximately 100 to 1, all with the full faith and credit of the United States taxpayer behind them. And Congress decided, in the immortal words of Barney Frank, to roll the dice some more on Fannie and Freddie and so-called affordable housing goals. And so you had a whole set of policies that incented, cajoled, mandated, suggested financial institutions loan money to people to buy homes they could not afford to keep. And so this happened system-wide. Now, the left has perpetuated a myth that there was deregulation. It's been fully debunked. On a quantitative basis, over the preceding decade, you had regulations increased by about 17%. Now look over the last couple of decades, whether it be FIRREA, FDICIA, Sarbanes-Oxley, all you had was an increase in federal regulation. You cannot intellectually make a case that there was any lack of regulatory authority to have prevented the financial crisis. Again, it had so much more to do with dumb regulation and, frankly, dumb and negligent regulators. We have to come up with a new system to make sure that we have a system that works for all working Americans and that we have credit markets that are affordable and available and competitive and transparent, that are vigorously policed for force and fraud. But you cannot do that unless you change the narrative. And we have to get out the true picture and the true facts of what caused the financial crisis in the first place. Now, there were a lot of contributing factors, but a garden variety recession never would have been a great financial panic were it not for bad federal policy and, frankly, the way the whole crisis was handled in the first place. To bail out Bear, to let Lehman go, nobody knew what the federal policy was, but ultimately you have what economists call moral hazard. And so when people are not having to engage in market discipline, but instead they believe that the full faith and credit of the United States will actually bail them out. And we saw that happen. Bailouts beget bailouts. And so unfortunately, Dodd-Frank hasn't fixed any of that. We have to fix the narrative. Winston Churchill once said that history will be kind to me because I intend to write it. We've allowed the left to write the history of the financial crisis. It has to be rewritten and the facts have to come to fore.
You know, if I were not knowing this, seems to me like you and Jeb Hensley sort of know each other, and maybe he was reading your script, was he? What really caused this thing?